that we are responsible to do good and to make the world a better place. And so whether it is using that money and that influence and people like you and I who are on podcasts to talk about, the horrors of human trafficking, or whether it's rescuing, the poor, or whether it's doing something else in our own community for foster children, whatever it is, I think we're deeply responsible. And we also are going to get a deep satisfaction out of this.
Hello, everyone, and welcome to the Moeller Real Estate and Business Podcast. I'm your host, Phil Moeller, and on this podcast, we will be interviewing guests that have made their mark in real estate, in business, and in other areas of life. Listening to podcasts myself has helped me in so many different ways and continues to do so. If you're a real estate investor or an entrepreneur, or aspiring to be either, or just someone that wants to learn, you've come to the right place. An easy way to have an impact is to share this episode with friends or family, provide a review, or just spread the word. We greatly appreciate it, and now let's get to the show. Hello, everyone, and welcome to this week's episode. I'm really excited for today's guest, Paul Moore. Paul, how are you doing? It's been a little while since I've seen you.
No, I'm doing great. It's great to see you again.
Yeah, you too. So Paul and I met, I bet that's been 2 or 3 years ago, in a time in the industry when everything was just great and going up and to the right, and things have changed a little bit, and we'll talk about that. But before we do, Paul, I really want to get into your story, your background. You eventually led to owning Wellings Capital. So first of all, you worked at Ford, but you built and sold a successful business. You became, I want to actually hear about the 2-time Michigan Entrepreneur of the Year finalist. That's really interesting. But then you discovered your passion for real estate, and I want to understand your story and what led to that. But also, you're talking about not just blogs, books, have been on HGTV, just really an investment expert, especially when it comes to private equity investment. So we'll get into that more. And then really a neat story and really a purpose behind your money that I want to get into a little bit later in the episode too. But before we get into some of that, tell me about your story. What were some defining moments? Who is Paul Moore? How did you come about?
Yeah, I went to work at Ford right out of my MBA at Ohio State, and a couple weeks in, I got bored. And I really loved Ford. I still respect the company, but I ended up there for about 4.5 years. But I kept trying to start businesses on the side. And finally, with a business partner who was also at Ford before that, we launched a staffing firm. 5 years later, it was discovered by a small public company, and we were sold. And I was 33 and a half years old, and I thought, hey, I'm a full-time investor now. And the truth is, I was not. I was a full-time speculator now. And you talk about me as an investment expert. I was the furthest thing from that. I mean, the MBA did not help because I had a speculative gene, I think. And so I did all kinds of investments that were really speculations and didn't do the due diligence I should have. And, I made a lot of money on a few of those, and I lost a lot of money on a lot of those, and just made so many mistakes. And so it really, taught me lessons. They didn't dawn on me till a decade or so later. But, investing is when your principal is generally protected and you've got a chance to make a profit. Speculating is when your principal is not safe at all and you've got a chance to make a profit. And I think it comes down to, what is wealth? What is wealth? It's not, the fancy cars and mansion and boats and all that. It's having assets that produce predictable cash flow. And that's also what makes the difference between an investment and a speculation. I can speculate on a little bit of Bitcoin, but I know that as it, sits today at $97,000, it could also drop to zero. And there's no reason it shouldn't or couldn't drop to a zero or go to 200,000 because it's not backed by an income stream. It's backed by human emotions. And but investing is entirely different. It's backed, investments are backed by assets that produce somewhat predictable cash flow, hopefully
So
produce appreciation as well. And that's what I really love uh, about what we're doing now.
Well, I really want to define so investment. So we'll have listeners that are real estate investors, active or passive business owners that maybe have their, maybe they have some real estate investments, but also they're in the stock market and just, public securities and whatnot. So when you define investments, can you clear, are you talking about all of the above, or are you alluding to specifically like real estate private equity investments? How do you define that?
I would say all the above. I mean, Warren Buffett has made a fortune in public equities, and we could certainly say that he's made good investments. So no, I would say all the above.
But and then how has your investment strategy um, changed from, I think you said 33 when you sold the staffing firm until now?
Well, I mean, and even just kind of half circling back to your previous question, um, I don't like investing in public companies. I don't like investing in real estate through, say, a REIT. There's nothing really wrong with it, but think about this. In a private equity real estate investment, there's a direct connection between the efforts of the property management team, the asset management folks, doing value adds, seeing increased rent, seeing increased income, and therefore a direct connection to the value and therefore my ROI. With a REIT or any public investment, it's deeply impacted by the mood on Wall Street, a CEO random tweet, a CEO scandal, a war in the Middle East. Those things probably impact my ROI more than the efforts of the people with their hands on the controls. And so that's why I love about real estate. Warren Buffett, Howard Marks, Charlie Munger, they talk a lot about um, intrinsic value, finding, Warren says, price is what you pay, value is what you get. Well, that's more true in private real estate by far than in public companies. And anybody who knows about the efficient market hypothesis knows that in public companies, generally, everything that should be, could be known about a company is already known. And generally, it's hard to get a really good deal because there's millions of eyeballs looking at that. It's
Yeah.
so different with private real estate. Our company invested in a mobile home park in Louisville right on the eve of COVID. We were there. I saw my first mask on an airplane, I remember, January 2020, and closed on it the end of February of 2020 and for $7.1 million with the goal of getting it to a value of 13 million in 3 years. That would have been a huge win. Well, our operating partner did 3 or 4 really good moves once he took over. By the way, the owner of this park hadn't been to this mobile home park in at least 5 years, maybe many more than that. Was completely hands off, was completely mom and pop. Lots of things were wrong about it. And he made 3 or 4 really quick, really good changes, including passing the utilities back to the 265,
Yeah.
residents,
Right.
simple things like that, and got an offer of 15 million within 10 months and closed on it by the end of
Wow.
2020. So, our $3.5 million investment, we were the largest investor of the 3.5 million in equity in that deal. It went to over 10 million in just 10 months. And so when you can do deals like that, it doesn't matter if it's in the middle of a pandemic or a Wall Street crash or a Wall Street run up. It's
Right.
based on the skill of finding the deal, operating the deal, and selling the deal.
Well, I want to use that as kind of because I want to ask a question and maybe help people think this through. But first of all, I want to go to two things. One, I want to talk about portfolio mix for somebody that might have heavy portfolio mix in private secure or public securities, but also like this concept. I was at a talk recently, like of an investment thesis and what that might look like for somebody. And so an investment thesis, anyone again should be thinking about what their investment thesis is, but and what are the elements of that. First, portfolio mix. I want to talk about that. Then let's come back to investment thesis. Portfolio mix, so like Bitcoin. I have a little bit of Bitcoin, but I'm not an expert on Bitcoin, and I know there's risk with that Bitcoin. That, as you said, that could go down, it could go up extremely, but I'm comfortable with the investment risk of it because of my limited knowledge on it, as an example. So how should we think about, or like just any guidance on our investment portfolio and the mix of that, and like relative to maybe risk and return, or however you think about it?
I think people should invest in what they know best. And, Buffett and Munger, for example, they don't invest. Well, Munger did some, but Buffett generally doesn't invest in real estate, though there's more intrinsic value in a whole lot of real estate than there ever would be in a public company. But he knows public companies. And I think we just need to invest in something we know, something we can safely, really effectively do due diligence on. Um, so for me, that's real estate. My one of our investment and director of investor relations, who spent 22 years or so on Wall Street, was shocked to find out I don't have any money in public securities. And I'm like, look, I've never succeeded at it. Charlie Munger said, why do we think we have an advantage in trading individual securities, individual stocks? He says, we don't build our own lawnmowers or design our own egg beaters. What makes us think we'd be experts in this? And what he was saying specifically is, unless you have some really, really, and I don't mean illegal, but I mean some inside track on a certain investment, why not, what makes you think you will beat the market when last I heard 93% of individual stock traders who make individual trades lose money, and
And
every single person I know that's traded actively has lost.
I think a lot of the population, their percent of their portfolio in public markets is probably, would you say, 75 plus percent? I would
Yeah, I'd say at
suspect.
least that. And I would say if you're buying the whole market, if you're buying an ETF or
Yeah.
an index fund, great. Warren Buffett recommends that highly, that almost everybody should do that. And that's one thing, and that's fine. But to trade individual stocks as part of my investment thesis would be foolhardy for me.
Yeah. And the other, I came across like a pie chart of the ultra wealthy and how they invest their money, right? And then you're going to see a very, very, very different strategy
Right.
than 75% or more in public securities. So
Yeah.
the ultra wealthy, what are they doing? They're about 25% maybe in public, 25% in private equity real estate, 25 or so percent in private companies, 10 to 15% in cash, because they're just really cautious, like really protecting liquidity. So um, there's going to be a spectrum and a range for people, but I do think you should just have a balance. Where are your investments? And you should be moving that, as Paul said, to what do you know? And not, so I want to bring that to this investment thesis concept of, first of all, we should all be thinking about what is our investment thesis. And I think a couple of elements of investment thesis are knowledge, control, and like, so I'll say public companies. If you don't have knowledge of that specific company or you have no control of it, there's risk with that. But how do you think about this? I guess, how would you say you would define an invest? How should someone in general define maybe an investment thesis?
Yeah, I'm speaking at the White Coat Investor Conference next week in San Antonio. And so we do talk to a whole lot of medical doctors, dentists, other IT professionals. And you know what they know? You talk about what you know. They know medicine really well. But for them to really become experts at real estate is a stretch. Something's got to give, whether it's their family life, their hobbies, their relaxation and rejuvenation time, something's got to give. And so for them to know medicine really well and know real estate really well, yeah, I have my doubts. So then you have to ask yourself, okay, if I'm in that situation, do I want to spend my evenings, weekends, vacations, lunch breaks chasing down houses to flip and real estate deals that usually don't pay as well as I expected and are way harder than I ever expected? Or do I want to, I mean, let's say I believe in real estate, then it becomes, well, if I don't know it super well and I don't have time to do due diligence a whole lot, then I've got to just back up and say, okay, who do I trust? Who do I personally trust? And can I vet them enough to trust them to make the right decisions? And of course, that's where we get into syndications like you have and funds like we have. Investors are trusting us to make those decisions. And of course, we could talk a long time about how important it is for us to steward their money well.
Yeah, and I think first of all, I think trust is important. I saw a graphic of like the three elements of trust, or like your connection, someone's competence around, like, so if you're investing in someone, you need to know their, not just their connection, competence, and character. So if you
Mm.
know someone's a good person, okay, good, that's a good checkpoint. But if they don't, if they're saying, okay, I'm a good person and I'm going to go take your money and invest in real estate, but I've never invested in real estate before, even though they're a good person, they don't have the competence, and you're connected to them. If they don't have the competence in that field, then that's probably not. You can trust them as a person in general, but not with your money in a real estate investment, maybe. So I think the elements of trust are important. And I think the other thing to highlight is, you didn't talk about how they should go study a bunch of different markets or a bunch of different deals or other, right? If you're going to be a passive investor, the biggest thing you need to study is the person you're giving your
Yeah,
money to.
that's right.
It's operator, then market, then deal, the debt structure. There's all those things matter, but you need to really make sure the person you're trusting with your money knows what they're doing is the most important thing.
Yeah, that's really good. I'm glad that you shared those three C's. I'm going to write that down. That's absolutely true. And, a great operator can turn around a bad deal, or at least, hopefully, I mean, in many cases, at
Yeah,
least some
agreed.
be saved, I'm sure. But a mediocre operator can ruin any deal, even a great one. And so we've got to look at the person and their team, their track record, their competence first.
Yeah. Well, how tell me more about, so for an investor that has 75%, maybe they're thinking about real estate as, I can go buy a house or a duplex or get started there, and they have 75% of their portfolio in, the public markets. What are some different ways they can get into real estate that maybe they're not even aware of, honestly?
Yeah, well, again, going back to Charlie Munger's egg beater comment, I would not, if I had another full-time career or passions or even enjoying retirement, I would not try to become a real estate expert. I would, again, go to find somebody I trust. And so the best way to do that I know of is if you're an accredited investor, and you can look up what that means if you don't know, but if you're a accredited investor, I would go out and I would do due diligence like crazy on operators and asset types. I mean, that's within your control. We want to see what we can control, what we can't. You can't control interest rates. You can't control the economy. You can't control oversupply in self-storage, but you can control where you invest and who you invest with. And so I would check out asset types. I'd want to get a mix between different recession resistant asset types, different geographies, different hand-picked, carefully diligenced operators, different strategies, and even different places in the capital stack. Now, it's hard to get diversification across all those, but it is possible. And that's what I would do. And I would go find some of those forums out there, and I could name a few if you want, Phil, but that allow people to do, deep dives on reviews of these different operators, and where they ruthlessly um, talk about their flaws and their good points and their experiences, and you can see trends on those different websites, and from that you can make your own decision. You can also get Brian Burke's wonderful book, The Hands-Off Investor,
Yep.
350 grueling pages of how to do due diligence on an operator and a deal. um, my friend Brian's getting ready to update that book. BiggerPockets will be publishing a new edition of it any day.
Okay.
So
Yeah.
that's what I would do.
And I would just say, so first of all, Brian Burke, The Hands Off Investor, great book on passive investing as an LP. But I want to ask a question about passive investing because I think there's a misunderstanding of the word passive and what that means. Because you did not say go invest in real estate and don't do anything, right? And I think there's just this misunderstanding that passive investing means I can just do nothing. Um, it maybe that's the case if you find really good like people that again you know like and trust and are going to do a good job and be good stewards of your money. But I just think a lot of people, and maybe this is even another transition, got burned by just trusting and passively investing,
Yeah.
and they're placing money in 2019, 2020, 2021, and all of a sudden maybe early 22, and the market shifted dramatically, right, and went in a bad direction. And a lot of syndicators and people that maybe didn't have experience or people that didn't do due diligence with different syndicators are struggling right now because of that or have struggled for the last year or two, unfortunately. So I guess what are your thoughts on that term passive? I think we're probably on the same page, and also this market and kind of what we've come through and what might be next.
Yeah, we've got a passive investment. We've invested over 50, maybe over 60 million with one operator that we're everything that they want us to invest in, we can write a check for in a day or so without really diving seriously deep, without doing the on-site visits and everything because we trust them so much. And so for that group, we're pretty passive. Let's go to the other end of the spectrum. We invested in another mobile home park operator that had a good track record, but once we got in with them in 2021, by 2022 or at the latest 2023, we noticed they were making their 8% distributions. But the financials weren't really clear to us how they were coming up with that 8%. And so we started diving deeper and deeper. And from the summer of 2023 to the fall of 2024, we harassed them. We had to. We harassed them endlessly to show us more data, show us their financials, show us how they were getting these returns. And it came to light that the money was coming out of invested capital. They weren't making a profit. And though they were still paying the 8% and they said things are going to get better soon, we were not comfortable with that. And so Phil, our harassing, and I know that sounds like a bad word, but we had to do it on behalf of our hundreds of investors. Our harassing turned into a buyout offer from them just to get us off their back. And they bought us out December of 2024. And we were so happy to get out of that. And honestly, if we hadn't been keeping our eye on the ball, we would have, I don't know where that's going to end, but it probably is not going to end well
Right.
for the other investors. But it seems to us that almost all the other investors are just happy to get their 8% a year and they're just moving right along.
Yeah. Well, what's interesting too, so I think to the passive point is you got to a point of being passive with the first group that you talked about because you just have a track record, so much trust with them over time. It didn't start passive, but now it's passive, I think. And then just you need, the less you know someone or an operator, the more active you need to be, and over time maybe it can become passive. I think is the lesson there. So let's talk about the market. There was a lot of pain in 2021, 2022, 2023. The pain wasn't there yet. Decisions made in that time frame led to pain in 22, 23, 24. Where are we at now? Where's this going?
Yeah. So I wrote a book called The Perfect Investment. I know it's a humble title. In 2020, let's see, 2016. Sorry, I got my brain was off there. And by 2018, I could see things weren't going well. I was in my mid 50s. I'd been around through the great financial crisis in real estate and other things. And I started realizing it wasn't just me. A lot of us started realizing, hey, this thing's not going to end well. This has all the characteristics of a bubble. I mean, not a good bubble either. I mean, we were being outbid as a multifamily syndicator by 20, 30, 35% on deals when we had already stressed, we were bidding the maximum that seemed prudent. and we were getting outbid by 30%.
Yeah, that doesn't seem
And
right.
and then those people were doubling their investors' money in 2 years from, let's say, 2018 to 2020. And, what's funny, Phil, is that those who take the most imprudent and craziest risks in a rising tide are rewarded the most.
Mm-hmm.
But they're also the quickest to go belly up when things go south. And so,
Yeah.
as it has been said, a rising tide lifts all boats. That was what was happening, and a lot of brand new operators go back to your three C's. Lack of competence. Even though if they had shiny, brochures and beautiful websites, they didn't really know what they were doing. They were riding this wave. And, think about it. If somebody takes 50% LTV on a deal and then they sell it 3 years later for a certain profit, if somebody else took 75% leverage on that same exact deal, the growth for those investors would be literally double what it was on the same deal for the person who took less risk. So they looked
Right.
really, really good. I
Right.
started calling them nurus, which is new gurus, people who were in junior high school during the great financial crisis. And by the way, there's nothing wrong with being in junior high school during the great financial crisis. But for them now to be taking tens and even hundreds of millions of dollars from investors and even making comments from the stage, like I heard one guy say, it doesn't matter what you pay for multifamily, it's always going to go up. You'll always be fine. I thought he was kidding, and he wasn't kidding. And so that went really, really south. We all know that. Rising interest rates, 11 interest rate hikes from 2022 to 2023 were not the problem. They just exposed the problem. The
Yeah.
problem was overpaying, over leveraging, overconfidence in underwriting, using risky floating rate debt. Those type of things were all exposed. And of course, 2022 to 2025, now we have a lot of pain out there.
Yep.
During that same time, we had a massive run up in development of new apartments. I believe it was 600,000 units in 2024. It'll be 500,000 in 2025, but it is going to drop like a rock starting in, completions, that is, in
Yes. Right.
2027, 2028. And there's already a 4.3 projected, I should say, 4.3 million unit housing shortage by 2035. And so this drop in development will probably make that imbalance worse. So we're faced with another huge run up on the part of, basically favoring syndicators, fund managers, and investors in this space. And I'm crying out to all of them again to say, look, don't blow it this time.
Yeah.
Don't turn what should be a safe and fairly safe, predictable investment into another casino like so many did last time.
Well, I think it's going to be really interesting, and I think yeah, the run up in even though there's been a big run up in supply, and especially in some like of the coast, southwest, southwest, southeast, there's been a big run up in supply. That doesn't mean there's still an overall shortage of supply, but the pace of the supply increase, the markets haven't been able to keep up with, which has caused rent deflation and other things in all those markets that I think are going to come the other way, as you said, in the next couple of years. So really interesting take on that. We could talk.
There was an article in the Wall Street Journal on February 14th called "We're Headed Toward a Landlord-Friendly Era," and another one in Business Insider this week, which is mid to late February, as we record this. America is about to enter an apartment crunch, and that's in Business Insider, and they do a really good job explaining what's going on.
Yeah. Well, I appreciate your insights on the market too. I want to talk about. I want to shift to, we talked about investment thesis, just real estate, private equities, kind of portfolio, where we are in the market. I want to talk about money and wealth and kind of what that means. How should we think about money? Maybe like what's our purpose for money? Because you just say in your bio, you talk about what you're doing, one of your causes behind it. So I want to get into that a little bit more. How do you think about, money financially? I think kind of from a personal perspective, Paul, if you're willing to share.
Yeah, I mean, this is going to get a little philosophical here, Phil, but um, I don't have the exact numbers right now, but I know I'm close. If you make more than $30,000 a year, you're among the 10% of the wealthiest people in the world. And if you make more than, I think it's 40 or $50,000 a year, you're in the top 1% of the most prosperous people in the world. And even if those numbers aren't exact, they're really close.
The listeners are in the top 1%, right? I mean,
Yes.
that's the listeners here are generally in the top 1%.
Yeah. And so I believe that we've been given a responsibility to steward the earth. And I'm not talking about global warming and stuff like that specifically, though that may be part of it. I'm talking about a responsibility to, not through taxation, but through generosity, that we are responsible to do good and to make the world a better place. And so, whether it is using that money and that influence, and people like you and I who are on podcasts to talk about, the horrors of human trafficking, or whether it's rescuing, the poor, or whether it's doing something else in our own community for foster children, whatever it is, I think we're deeply responsible. And we also are going to get a deep satisfaction out of this. We're not everybody who has bought that fancy car that they had their eye on, or that electric guitar that they always wanted. Look, there's mine. Uh, Everybody who buys that, realizes, it takes about what, 3 days, maybe 6 days for that shine to wear off.
Yeah.
And often a lot of it traps us into something else we have to maintain,
Yeah.
like a boat. The happiest day of any boat owner's life is the day they buy. The second happiest day is the day they sell it. And so there's a deep satisfaction in when we use our wealth well. And that's kind of what I would say about that.
Have you always, I mean, so have you always thought about it like this? Have you, or how has your mindset around money and the purpose for money changed over time?
Well, I have always thought about it mostly that way. I had a crisis moment. I had a couple $1 million in the bank when I sold my company at 33. Exactly 10 years to the month later, I had $2.5 million in debt. And that debt was all tied to real estate. And of course, we all know we were on the hurtling right on the edge in the fall of 2007 of going over a cliff. And we didn't know, nobody could know how bad it was going to be. It's easy to think we could. But at the time, we thought maybe the worst is over in the summer of 2007. It was kind of getting bad already. Um, but I had a crisis, and my business partner quit, and he signed all the debt over to me, and we're still friends. But anyway, I had this crisis, and I asked myself, okay, I was just reading these biographies of a great man who took care of orphans in Bristol, England, named George Mueller. He lived all the way through the 1800s, and in summary, he raised something like $250 million in
Wow.
today's dollars, all without asking for money once. It's a long, amazing story. And he took care of up to 10,000 total orphans, not at once, but over time. And anyway, I thought, what would he do? And I realized, well, he would do something really radical. First of all, he wouldn't be in debt. So I had that strike against me. But secondly, he would do something really, really radical. And so I announced to my CPA, my friends, and my family, hey guys, we're going to give our way out of debt. And that's about how it went over right there. Dead silence. What are you talking about? So our family went on this adventure January 1st, 2008. We started giving a certain amount per week to causes we cared about. And we said, God's either going to bail us out of this or we're going to go bankrupt. And either way, it is what it is. And so within 4 weeks, by the last day of January, I had met with a friend of mine and had this amazing light bulb moment of how to subdivide a large waterfront property I had that was absolutely not subdividable. And I went down to the county, I gave them my plan. The lady looked at me like she shook her head and she said, in 30, I think she said 35 years of working here, nobody's ever come up with a plan like this to circumvent our law. And then she started laughing and she said, but you sure did. And you're right, you can do this. And so
Wow.
that led to a lot of a lot of sweat, a lot of hard work, a lot of prayer, a lot of, effort. But 13 months later, we were completely debt free. We even paid off our house right in the middle of the great financial crisis.
Wow, that's a phenomenal. I got chills from that story. And honestly, I, I think there's this. I think people think about this in purpose of money in a hierarchy of needs in some way, but I think the question for people is, what is that priority for you? And are you, when you put food on the table, when you have your living, is it the fancy cars, and are you prioritizing giving? Where's it out? And you know, a lot of people talk about this, but the earlier you prioritize giving, whether you're making 50,000 a year or 200,000 a year, it's harder to get to that giving number that you want to hit, if that's a percentage or whatever, if you don't start early on, right? So I would just encourage people to really think about what you're doing with your money, where it's going. I know, Paul, you're passionate about a lot of different organizations. The other thing I heard, by the way, is not just, you don't just give your money away, but it sounded like you were active in it. You weren't just sending checks, but you were going out and spending some time to get to know these charities and get more involved.
Yeah.
Is that kind of your philosophy around that?
Well, Wellings Capital, we take a lot of time to get to know our operators up front. And when we decided as a company we wanted to get behind a charity, we did the same thing. We, went to meet them in person. We looked very hard at their books. We looked at their charity navigator ratings, which were amazing. And we decided to get behind them publicly as a company. The organization's called AIM, AIM. Their website is aimfree.org. And, we were amazed to find out, Phil, that if you took the record profits, not the average, the record profits of ExxonMobil, Nike, and Walmart, added those record profits together and tripled that number, you get to the approximate annual profitability of human trafficking. It is a modern day scourge. We're almost 200 years from the end of slavery in the UK and then shortly after in America. Yet there are an estimated 50 million slaves on the planet right now. In fact, hundreds of children have been captured or sold into slavery since you and I started this podcast. And so we can't solve all that, but we have raised, influenced, and donated over $800,000 since we started in November of 2021 working with AIM.
How much of, first of all, there's an organization I support too, but I'm going to check out aimfree.org. For sure, there's an organization, Error Recovery. We talked about a little bit. You heard Jeremy
Yeah.
Locke speak. But just it's horrible. I mean, it's just a really horrible thing. And to put it that way, yeah, we are not living in a slave-free world, right? There's 50 million slaves, and it's horrible. So, Paul, how much of now this purpose for money and what you're doing here is really driving you to keep going with real estate and growing is it to grow wealth, or is it to grow giving? Like, how do you think about it now? Is this the real driver and the purpose behind what you're doing?
You know, you caught me off guard with that question, and I'm going to have to try to answer that as transparently as I can. Um, I think what we do for our investors, I'm so passionate about it, and we haven't really talked much about that, but we're a fund that pulls together the best operators we can find, best deals we can find. We provide diversification across geographies, operators, asset types, strategies, and capital stack positions. We're so passionate about that, and we believe in that's kind of our first driver. And I know that doesn't sound as amazing as if I said it was all to set free, another 10 slaves. But that's very important to us too. But we're thinking mostly about our 950 investors and their families and giving them the greatest experience we can. And then for me personally, when I see the wealth come in, like when I see a bunch of these funds and projects close and I get checks, hopefully for hundreds of thousands of dollars, I'm absolutely bent on figuring out how I can give it and give it effectively to these different organizations. And my wife, who's in the other room here in my home office, she's like shaking her head, probably going, "Don't forget, we've got to." So she's a more balanced, so she really helps me out in that area. But so it's both.
Yeah. No, I love that answer, and I think it speaks to, look, you're serving others. So you're serving investors, and that's a priority and a responsibility. By the way, the fact that you're talking about giving and supporting human trafficking, your investors are clearly hearing that too. Now it's up to them to decide what they do with their wealth and their money, but
Right.
certainly you're influencing that in a good way too. So I would not shortchange yourself for that. And I really just appreciate the transparency and authenticity of that answer. So I want to kind of wrap up here, Paul, with, if you just step back and reflect and think about your career, what you've done, the investors you've helped, the charities and organizations you supported, how does what you do, how does it make you feel?
Well, I will say, I had a podcast for 4 years called How to Lose Money. It was a wealth building podcast, but I made a ton of mistakes early on. And as I reflect on those mistakes and, speculating instead of investing and all that, I really wish I would have made better choices early on. I wish I'd have been in commercial real estate from day one. Now that I know the power of it to build and maintain wealth. But um, overall, I'm even glad for the failures. I can see the good in all those early, like 1999, 2000, 2001 failures. That's where a lot of them were, right in that 3-year period. And I see the good in it because I've written countless blogs and been on a number of podcasts talking about this, and it really makes us much more driven to be careful now. We said no to a perfectly good deal the other day from a perfectly fine sponsor because their SREO, their schedule of real estate owned, showed some problem properties. And we saw, not one average investor in 100 would look at that and really and walk away from a really good deal.
Yeah.
But we did that, and it makes me really happy to know that for our 900 plus investors, we did that for them.
Yeah.
It's going to make it harder for our team because now we got to go find another deal to put that money into. But it makes me really, really happy. And when I think of the children that have been rescued through AIM and the other stuff we've been involved in, it makes me overwhelmingly happy.
Yeah, that's amazing, Paul. And I think you could just hear your mindset of, if you can say, yeah, okay, we could have done things differently, but we're glad for failures because we've learned so much. And then again, a lot of times through failures, you're putting yourself in a position to help a lot of other people out, right? You can tell your story, you can share that with others, you can place money better, things like that. So whether that's financial or otherwise, we do learn a lot from failures. And I think it's our mindset and frame, how do we frame failures is what I think is so important. So Paul, you've been great. We just covered so much. I want to add, how can people find out more about you? Where you want to direct anybody to a website or anywhere to learn more about you?
Yeah, we've got some free resources, including an introduction course to commercial real estate investing, courses, ebooks, I should say, on mobile home parks, self-storage, RV park investing. It's all at Wellings Capital. That's WELLINGS, wellingscapital.com/resources. And that'll get you right to that free stuff.
Great. Paul, thanks so much again. Your story, portfolio investment thesis, kind of purpose for money, real estate, private equity, real estate, of course, and definitely check out Paul. He's get to know him, but I'll just say a man of high character. I appreciate you coming on the show, Paul.
Thanks, Phil. It's been a real honor and a joy to be here.
Thanks so much for coming on the podcast. Until next time, signing off. Thank you for listening to the Muller Real Estate and Business Podcast. We hope you found today's episode helpful. If you know current or aspiring investors or entrepreneurs or anyone that would benefit from today's episode, we appreciate you sharing it with them, or better yet, providing us a 5-star review. To learn more about Muller Real Estate, visit our website at www.mullerre.com. You can also sign up for our newsletter or local events via our website. In closing, I encourage you to be purposeful in all areas of life, educate yourself, network with others that have been successful, take action, and lead. Thank you.